There's a whole lot that goes into hosting the Super Bowl. I don't mean at your house. I mean at a stadium. You need two great teams, a killer halftime guest, tons of food and amenities, and of course a mega-sized stadium to hold it all. But they don't come cheap, as we know, which is why a combined $13 billion in public subsidies was proposed last year to finance pro stadiums in 12 different U.S. cities. But that only covers a portion of the total cost. Who pays the rest? And are stadiums a good investment? Let's ask Dan Close. He's head of municipals at Nuveen. Dan, it's great to have you. My knee-jerk reaction is like, I can't imagine they are. They always seem like a boondoggle. But what can you tell us?
Yeah, and it's the entire idea of using muni bonds to finance arenas, to finance stadiums. It's for professional sports. It's a controversial topic in munis, and we don't have many juicy, controversial topics in munis. But if I could, just as far as two quick background points before getting into how you could profit from it. One is when you have local officials and state officials want to go in and use taxpayer dollars and use muni bonds to put together a stadium or an arena, it's with a thought that it's going to go in and spur economic growth. It's going to spur jobs. You're going to have bars and restaurants come into an arena district in Columbus, Ohio. You're going to go in and have all this knock-on effects.
And it can often work.
And it can often work. I mean, the results are mixed. I mean, you do have like Cobb County that clearly has benefited from moving the Atlanta Braves and going in and having the knock-on effects there. And there's some that don't work as well. But the other thought is that when you think of stadium financing, it's not for the scoreboards. It's not for the different parts in the actual arena or the stadium, the luxury box. It's all the wraparound financing. So the Chicago Bears, my Chicago Bears, are asking for $2.4 billion for their new lakefront stadium. And
when you say asking for, is that from the market? Is that from public subsidies?
Yeah, it's from public subsidies, from ultimately issuing muni bonds for these. And it's for public transportation. It's for putting in a new road. It's for putting in greater utilities, water and sewer. And as you mentioned in your opening, there are 13 billion being asked for by 12 different cities. And we're going to see, I think, more issuance coming from this in the coming year as these become more expensive.
And it's tricky because a lot of the fan base loves it, right? I mean,
who
wouldn't want a great stadium, a great experience? We all complain about getting back and forth to games and that kind of thing. But is it a good investment?
Yeah, and I think that's what we really focus on our most recent paper is the difference between the perceived risk that your team has to do well. My Bears won 5 games last season. It's very difficult to go in and to watch this and say, gosh, I've got to make sure my team's doing well and people are showing up, versus the actual risk. And the actual risk these are bonds that are generally very high grade. They are Buffalo.
Meaning higher risk.
Well, high grade on this meaning.
Oh, no, high grade. I'm sorry.
Yeah, I mean,
not high yield. Yeah.
So if you look at the Buffalo Bills, they just issued $500 million of debt, and that debt all came from a AA county that is a very, in our opinion, a low risk. The Tennessee Titans just issued $750 million in debt from the city of Nashville. Again, we think very low risk. And so that difference between the perceived risk of you have a project finance and it's got to do well and your team has to do well versus what the actual risks are of, in the case of Tennessee, the state came in for a $500 million issuance of a AAA rated entity. The actual risk is much different. And so you can really profit from going in and buying these on new issue because there is that difference in what is being financed, which is stadium and assumed to be risky, versus what it's actually backed by, which is sales taxes and general obligation
bonds. Not to make the analogy, but it's kind of like mortgage-backed securities, right? You think, well, I don't want to back any homeowners risk, but if the government is basically going to backstop the default, then I could. So the strategy, you think, is actually to buy some of these on issuance because it's when they get the headline risk. There's a lot of concern. Maybe they have higher yields because of that perceived risk, but in reality, they're often backed by the stronger state and local government.